Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. during the first quarter of 2018. During the first quarter of this year, the key findings from the Emerging Trends in Real Estate report by PricewaterhouseCoopers and the Urban Land Institute, and the actions of the Federal Reserve as part of its Federal Open Markets Committee operations were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview in mind, let me now turn your attention to the primary events that have transpired in the residential housing environment. For the first quarter of 2018, a report titled Emerging Trends in Real Estate was worthy of discussion. The report, undertaken jointly by PricewaterhouseCoopers and the Urban Land Institute, provides an outlook on real estate investment and development trends, real estate finance and capital markets, property sectors, metropolitan areas, and other real estate issues throughout the United States. The following points are an excerpt of the key findings that can be used to help prospective homebuyers analyze the real estate market in their community before purchasing a home. First, a general theme of this report is that prospective homebuyers can expect a long glide path for the economy and for the residential real estate industry. This means that a sudden drop in residential real estate is not in their forecast. Second, residential real estate pricing in both primary and secondary markets has regained all of the losses experienced in the global financial crisis. Third, there are no signs of irrational exuberance among lenders. Many potential borrowers and deals out there are seeking funding. That puts lenders in the driver's seat. Fourth, between 2007 and 2016, the insured property losses from natural disaster catastrophes exceeded $200 billion. It appears certain that the 2017 natural catastrophe damage total will hit an all-time high. Fifth, the London Interbank Offer Rate, otherwise known as LIBOR, is being phased out between now and 2021 due to its role in causing the global financial crisis. From a real estate standpoint, variable rate financing, such as construction loans and adjustable rate mortgages, are pegged to LIBOR. The phase out of LIBOR will have a big impact on the real estate industry. A new benchmark to replace LIBOR will likely be based on data from active markets in swaps, currency instruments, interest rate instruments, and treasury repurchase agreements. However, to date, a new index has not been developed. 6. The phase out of LIBOR will cause many homeowners to have to sign a redrafted mortgage lending contract. Seventh, the phase out of LIBOR may also put downward pressure on interest rates because substitute benchmark proxies that are being considered typically have lower yields. Eighth, data from the Federal Reserve show year-over-year growth in mortgage debt outstanding at 3.7%. Ninth, depository institutions hold approximately $4.6 billion in mortgage debt, or 32% of all mortgage loans outstanding. 10th, since the government took Fannie Mae and Freddie Mac into conservatorship in 2008, the GSEs have contributed tens of billions of dollars of net profits to the U.S. Treasury. For more information about the proposed policies to reform the GSEs, please watch our Q2 2017 Residential Housing Market Review. 11th, home ownership rates had inched up consistently from a 50-year low of 62.9% in the second quarter of 2016 to 63.7% in the second quarter of 2017. Home ownership rates among the young adult part of the ownership spectrum are stabilizing after an extended period of decline. Home ownership rates among 65-plus-year-olds are also holding strong versus historical patterns. 12th, broad consensus supports a coherent climb in most of housing's key performance indicators through 2019, with total housing starts stepping up from 1.26 million in 2017 to 1.36 million in 2018 to 1.44 million in 2019. Single-family starts, most forecasts assert, represent about 3 out of 4 total housing starts during that period. For more information about the U.S. residential housing market, please watch our catalog of movie presentations on the Adkins Capital Management website. Moving away from these policy issues and events, and to an assessment of the mortgage lending environment, it is important to note that for the first quarter of 2018, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 4.15% and ended the quarter at 4.54%. Since June of 2011, the national average mortgage loan interest rate for a 30-year fixed-rate loan has been less than 4.61%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realizing expected labor market conditions and inflation, the Federal Reserve elected to raise the range for the target federal funds rate by 25 basis points from 1.25% and 1.5% to 1.5% and 1.75% during their Q1 2018 Federal Open Market Committee Operations meeting. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. Prospective homebuyers can use the Adkins Residential Home Valuation Analyzer in order to assess the impact of a changing interest rate environment. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Adkins Residential Home Valuation Analyzer. Now that I have provided an overview of how the Adkins Residential Home Valuation Analyzer is utilized, let me provide an overview of the home price level for a select group of cities across the U.S. For the first quarter of 2018, 18 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Honolulu, Newark, San Diego, and Bridgeport were identified as the 5 most overpriced cities in the index. While San Francisco and Honolulu and San Diego and Bridgeport had the same justified percentage of household income amounts, San Francisco and San Diego were classified as the most overpriced cities due to their higher required median household income amounts. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 4.54% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the justified percentage of household income amount. As an alternative, in order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $74,942 and $178,017. Finally, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $164,573 and $385,302. Prospective homebuyers can use the Adkins Residential Home Valuation Analyzer in order to assess the price level of homes in their community. On the other side of the spectrum, 32 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the first quarter of this year. Detroit, Buffalo, Wichita, Cleveland, Huntington, Portland, and Cincinnati were identified as the 5 most underpriced cities in the index. Wichita and Cleveland, and Huntington, Portland, and Cincinnati had the same justified percentage of household income amounts, which were 15% and 16% respectively. Therefore, these cities were ranked according to their justified mortgage loan interest rate amount, because interest rates would have to reach these levels before these cities would be classified as overpriced. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 4.54% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the cost of a mortgage loan. Prospective homebuyers can use the Adkins Residential Home Valuation Analyzer in order to assess the price level of homes in their community. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.